All right, today we are tearing into a really sharp analysis of the U.S. economy. It comes from the Macro Butler, and they're making a pretty bold claim. All that good news you're hearing about inflation, yeah, it might just be an illusion. So let's get right into it.
So the latest inflation number, the CPI, came in at 2.7%. You saw the headlines, right? Everyone was cheering, calling it this major victory. But the Macro Butler is kind of stepping back and asking a pretty important question. Is it really time to pop the champagne? Not so fast. According to them, this isn't the end of the story. They see this as, and I love this quote, inflation taking a short smoke break. It's just a temporary pause, a quick break before the real show begins. So what exactly are they seeing that maybe the mainstream narrative is missing?
To really get their argument, we've got to look past that one single 2.7% number. We have to break down the components, because the real story, as they say, is in the details.
Okay, so this is the chart everyone's looking at, and you can see why, right? That's a clear downward trend from the peak, and it's fueling all this optimism. On the surface, it looks like, hey, problem solved. But let's start peeling back the layers here.
Next up, we have core CPI. Now, this is what the Fed really watches, because it strips out the noisy food and energy prices. And at 2.6%, it's the lowest it's been in years. So again, looks like fantastic news, doesn't it?
And check this out. Even the really stubborn parts of inflation seem to be slowing down. This is owner's equivalent rent, or OER, which the Macro Butler sarcastically calls the CPI's resident zombie. It's famously slow to change, but even it has cooled to 3.4%. So far, you'd think everything is pointing in the right direction.
But here is the first real crack in the happy story. This is super core inflation. It's a key metric for the Fed. And yeah, it cooled this month, but that was after 5 straight months of it heating back up. That's not a victory. That's a brief pause in a pretty worrying trend.
And this slide right here, it perfectly captures the market's own skepticism. I mean, if the news was so great, you'd expect a massive reaction. Instead, key things like the 10-year Treasury yield and the dollar index, they barely budged. That tells you the smart money isn't exactly buying the celebration.
So, if the official numbers might be a little misleading, what's the real thing driving the American economy? This question brings us to the absolute core of the Macro Butler's entire argument.
The newsletter poses this question directly. They argue that focusing all our attention on the Federal Reserve and its interest rate policy is, well, it's a total distraction. The real answer, they claim, lies somewhere else entirely.
And here it is. This is the centerpiece of their whole thesis. Forget the Fed for a second. Just look at this. On the left, you've got inflation mapped against U.S. debt. On the right, the misery index. That's inflation plus unemployment against the exact same debt. The correlation is just undeniable. The source argues the true engine of our economic pain is reckless government spending.
Now, the Macro Butler does not mince words here. They place the blame squarely on policymakers who, in their view, have been chasing these economic theories that look great in a textbook but completely fail in the real world, leading us to this mountain of debt.
Okay, so let's bring this down from that 30,000-foot view of policy to what's actually happening on the ground. Because according to this analysis, the official national picture is hiding a deeply, deeply divided country. So the newsletter argues that obsessing over a metric like GDP is like, and this is another great line, diagnosing heart failure with a bathroom scale. You want a better measure of a nation's true health? Well, how about its actual health? With 40% of adults classified as obese and diabetes rates soaring, they suggest the real economic indicators point to a deep societal sickness that GDP completely ignores.
And this chart just lays the economic divide bare. The American economy is basically running on 2 completely different tracks. Get this, the top 10% of earners are responsible for a full half of all consumer spending. Meanwhile, the bottom 60% of the country combined they only account for a quarter. It's an economy being driven by a wealthy few.
So, how does the rest of the economy survive? Well, debt. And this leads to the endgame described by this really powerful quote. It's a situation fueled by things like 50-year mortgages that basically create a nation of perpetual renters.
And we see this playing out in real time. Cyber Monday hit a record, which on the surface sounds amazing, but look closer. Over $1 billion of that spending was fueled by buy now, pay later services. The source argues this isn't a sign of consumer strength, it's a sign of financial fragility. We're just papering over the cracks with new and easier forms of debt.
And this chart really reveals who is being forced to lean on this debt. It's disproportionately young people. And what's really alarming here is that they're not using it to buy luxuries, they're using it for essentials, for groceries. It's become a coping mechanism for an economy that's just squeezing them dry.
So, given this pretty bleak diagnosis, what does the Macro Butler suggest for investors? How do you navigate an economy that they see as being fundamentally broken? This brings us to their investor playbook.
They predict a very specific outcome that they call Trump stagflation. Now, this isn't your normal recession. It's what's called an inflationary bust, a really painful scenario where the economy stagnates, growth just stalls out, but prices for everyday stuff remain stubbornly high.
So here's the crucial part. What do you actually do? Their advice is pretty clear. First, stay away from long-term government bonds, because those just get crushed by inflation. Instead, they say, favor stocks of companies that have enough power to actually raise their prices. You should also hold physical gold as a hedge against chaos and, institutional decay. And finally, just buckle up for more volatility and expect pretty mediocre returns overall once you factor in inflation.
And the source argues this shift is already happening right now. This chart tracks the S&P 500 against the price of gold. And what's the big takeaway? That falling line means that gold, the ultimate safe haven asset, is starting to outperform stocks. And historically, that is a major warning sign.
Ultimately, the newsletter ends not with a stock tip, but with a historical warning. It frames our entire economic situation as a symptom of a much deeper decline, arguing that history teaches us that great nations don't fall to outside enemies. They rot from the inside out, through debt, delusion, and just plain bad decisions. Well, that was just a quick look at a really detailed analysis. If you want to go deeper into the data and all of the arguments, you can find the full newsletter right on the Macro Butler's website. We'll be sure to link it for you. Thanks for tuning in.